Capital gains tax. Okay, so first we understand what is a capital gain. So capital gain is actually that gain which you make from the sale of an asset at profit. Let me first define the two words, okay, before we move on. There is a word which we call as profit, and there is a word which is we call gain. Now, both of these are examples of income. They are in our income. But the difference is that profit, it comes from your operations. So whatever you do, whatever is your primary activity, when you work for that, when you provide the goods and services of your main course of business, that is called profit. Sometimes we also have a very specific word, trading profit. Gain is actually that income which is not coming from my primary course of business. This is coming from other sources. For example, if you are a business, but you do have some spare cash and you put it in some bank, or you purchase some shares, you get some dividend. So you have dividend income, you have interest income. Sometimes the value of your property goes up. So if the value of property goes up, of course, there is you do have some income over that because you made some gain. So we call it revaluation gain. So if the value of the property goes up and you made $100,000, you don't call it a profit of 100,000 because profit is very much related to your operating activities. It is something which you are making from your operations. Okay, so this is the difference. In terms of capital gains, so capital gains means that we keep assets not for the purpose of selling, but we are keeping assets for the purpose of using. You've got a motor car, you've got, a premises, maybe you have some other equipment which you are using in the business. And then a time comes then when you feel that I don't want to use it anymore, I want to sell it for some reason. And while selling that asset, if you sell it at more than the balance sheet value, then you call it a gain. So if an asset is recorded in my books as $100 and I sell it for 120, see, I'm not talking about inventory. Remember, if I have inventory of 100 and I sell it for 120, there is a $20 of profit because selling inventory is my primary course of business. It is my main course of business. This is my primary activity. But if I have a non-current asset are not kept in the business for the purpose of selling. Maybe I had a motor vehicle of $1,000 and I sell it for 1,300. Now I make $300. This is called gain. I had some premises, some property, its value goes up. I had a gain. So this is the difference, okay? So first, gain you understand. And when we say capital, so in accounting, always remember we say capital transactions, capital assets, capital budgeting, all these. Whenever we use the word capital, it means we are talking about like, okay, one is capital alone, like capital is equal, capital of the business is equity plus debt in the financial management. That's a different concept. So, but if capital alone is used, that is equity, debt, your capital structure. I'm not talking about that. But when capital is used with other words, like capital asset means non-current asset. Capital gain means gain on the non-current assets. You've got capital budgeting. Let's make a capital budget. Capital budget means making the budget for non-current assets. Capital budget. Okay. So a capital gain is the taxable profit on the disposal of an asset or investment. Either it is asset or investment. Investment means you might have purchased shares in some other company. Most assets or investments being disposed of are chargeable assets. Chargeable assets mean those assets on which you have to pay the tax. However, some key exemptions exist, which means that on some assets, you don't have to pay. Even if you made a gain on those assets, you don't have to pay the tax. So what we understand, it said that most assets are chargeable assets. Chargeable assets mean those assets that if we make a gain on the sale, we have to pay tax. This is most, but there are some exemptions as well. Private motor cars for personal use, qualifying corporate bonds. So private motor car, if I have a car for myself, for my personal use, and I sell it, it's only one car. On gain, I don't have to pay the tax on that. Qualifying corporate bonds. These are those bonds which are qualified. We call them qualifying because the government have put them into that category that, okay, if you pay purchases or if you purchase these bonds and then at the time of selling these bonds you make again, you don't pay the tax. So this is kind of a special provision by the government for tax exemption. Chattels bought and sold for less than 6,000 pounds. First of all, what is chattel? Chattel is a tangible, movable property. Chattel is a tangible, movable property. So house is not a chattel because house is not movable. But if you have furniture within that house, that is a chattel. Maybe some wall paintings, chattel. Even your motor vehicle, car is a chattel. So tangible, movable property. If they are sold for less than 6,000 pounds. So if you have any such personal possession like furniture or something, and you sell it for 1,500, you actually bought it for 1,000 and you sold it for 1,500. So apparently there is a 500 pounds profit. But because you are selling it for less than 6,000 pounds, you don't pay any tax on this amount. But remember that this amount 6,000, this is as of today. And in the tax law, it might change. So it is possible that, in the next Finance Act, they might make it from 6,000 to 6,500 or whatever. Wasting chattels. Wasting chattels are those who have a life of less than 50 years. Tangible movable property with a life expectancy of less than 50 years. There are some chattels which have a life of, for example, I can call it furniture. I think furniture is not used for more than 50 years. Maybe I can call it computer. Maybe I can call it my car. These all are called my wasting chattels because I don't think that a car is used for more than 50 years. Okay. There are some chattels which are called non-wasting chattels. Non-wasting chattels, they have a life of more than 50 years, which means that these are tangible, movable property with more than 50 years life. You are thinking, which could be those? Yes, jewelry. Jewelry has a very long life. It could even go for centuries. Paintings, very long life. 50 years is not the case. So there are wasting chattels and non-wasting chattels, but exemptions are given to the wasting chattels. Gifts to charities of land, building, and certain works of art. If you make some gift to some charity, gifts of any type of asset to government institutions and museums. So these are those ones which are exempted. How is the capital gain tax calculated? Now, this is the question. Of course, I'll show you some basic calculation here, and then we will have additional calculations, probably with bit more complications when we do the practice question sessions. So first you see what is the proceed, how much you sold the chattel for, or you sold the asset for, minus the cost of the asset, less allowable costs. Less allowable cost. What are allowable cost? Initial purchase cost incurred, improvement and enhancements, not repair, improvements and enhancements if you have done, because improvements are added to the cost of the asset. We understood it from financial reporting as well, that when you increase the capacity or when you enhance an asset, that becomes part of the asset. So maintenance costs are not allowed, but improvements are allowed. Cost incurred to sell the asset. For example, if I make it very simple, let's make it like this. I sold an asset for 1,000. Initially, I purchased the asset for 600. I also incurred some enhancement cost of 100. I also paid some commission to someone for selling the asset. So now this is my cost of the asset, and this is cost of selling the asset. And when I subtract all three of them, 750, 250 is my gain. So initially I purchased it for 600. Then after 1 year, I spent $100 more for some kind of enhancement. Then at the time of selling, I put $50 as a commission. So from 1,000, I subtract that as well. Indexation allowance is also given. Now, what is that indexation allowance? Indexation is actually to, cover the impact of inflation. For example, let's suppose like this. If you purchase something at a cost of $5,000, like, 5 years ago, and today you sell it today for 5,200, let's suppose. Did you make some profit? Did you make some profit? Apparently, it looks like that, yes, you did make some profit of $200 because it was bought for 5,000 5 years ago. You are selling it today for 5,200. So apparently, there seems to be a profit, but in reality, there is not, because this 5,000 5 years ago was a bigger amount. Money loses value with time. This 5,200 of today is not more than that 5,000 actually. This 5,200 which you are considering, it is in fact less than that 5,000 because of that inflation impact. Because of that inflation impact. So indexation is a way to, because if this is the situation and the tax department comes and say, oh, you made a gain of 200, pay tax on that. And I'll say, see, this 5,200 is nothing as compared to the 5,000, the value of the money, the value of this 5,200, its value today is less than the 5,000 which I had before, because money loses value with time. So to cover this aspect of inflation, the tax authorities, just to show their fairness, they give you indexation allowance. This simply increases the cost of the item for inflation, and so makes the profit you are taxed on less. So they decrease. So for example, they would say that, okay, 5,000. Okay, let me just explain and then I'll give you example. For example, you buy an asset for $100 10 years ago. You sell it this year for 150. Indexation allowance for this period is 30%. Capital gain tax is 25. So if you don't have any indexation allowance, you would say that I purchased it for 100. I'm selling it for 150 and I made a profit of capital gain of 50. And then on 50, I have to pay the tax. You calculated this $50 gain without indexation. But if you do it with indexation, then what will happen? Indexation allowance for this period is 30%. So you should say that my proceeds are 150, cost is 100, indexation is 100 into 30%, $30. So profit is 150 minus 130, not 150 minus 100, not 150 minus 100. In fact, profit is 150 minus 30, $20. And now you tax only on $20. So $20 into 25%, $5 would be your capital gain tax. This very simply, nothing more to explain. Indexation allowance is there to cover the impact of inflation, and indexation allowance, it decreases your tax expense. It decreases your tax expense. Now, this is very important to remember. Important to remember. Indexation cannot create or increase a capital loss. It cannot increase the capital loss. If there is a gain before indexation allowance, the allowance can reduce the gain to zero, but cannot create a loss. Cannot create a loss. For example, you purchase this asset for 100 and you sold it for 120, let's suppose. So then what will happen? You would say, I sold it for 120 and my cost was 130 before indexation. So I actually making a loss, and therefore I need some relief. So it cannot happen like this. It can maximum make it zero. So through indexation, you cannot go into loss. You can only decrease the tax liability, but you cannot go into loss, and you cannot claim this loss from some other profits or gains. So this is important to remember. Then you've got how the capital gain calculated, rollover relief. There is another topic. Now, this rollover relief is also related to capital gain tax. For example, let's suppose that you purchased the asset for 100. You did the indexation for 30%, which is 30. So you said that I sold it for 150 minus the cost plus indexation is 130. My tax is 20. My gain is 20. On this gain, I need to pay 25% of the tax, which is $5. This is what we just did in the previous slide. Now, the question is, you sold it for 150, you received cash. What are you going to do with this cash? Sometimes businesses, they sell the assets and they keep the cash. If they want to keep the cash, they have to pay the tax. But it is also a possibility that this is an old asset and I want to sell it and buy a new asset. I don't want to keep the cash. I'm actually replacing the asset. So if at the time of replacing the asset, if I pay tax to the authorities, I will not have cash enough to buy the new asset. Plus, asset is not being sold, asset is just being replaced. So selling and replacing, my objective is not to sell it, my objective is to replace it. So whatever cash will come from here, that is going to be reinvested into another asset. And if in between the tax authorities come and take the money, how am I going to buy the another asset? So I tell the tax authorities that please do not take this tax now, because I'm going to buy a new asset. And then if the next asset will be sold and there will be some gain and I don't have to replace that, then I will give it to you. But if the second asset is replaced with the third, then you don't have to give. So we call it rollover relief, which means you defer it. So it's a relief, but it's a temporary relief until you sell the next asset and you make a gain or loss, whatever, you make a gain on that. And then if you are keeping the money, you have to pay tax. But if you say, no, I'm going to sell the second asset and buy another third one, then again it will continue and you will never pay the tax. So it is called rollover relief. So rollover relief says where an asset is sold for more than its cost, capital gain tax will be payable on the amount of capital gain, $5 we calculated. However, where the full proceeds, not part of the proceeds, full proceeds from the sale of the asset are reinvested, like $150, in replacement assets, the tax due on the capital gain is deferred. Deferred means that it is pending to the next period. It is pending for the future. How much for the future? For an indefinite period of time until you convert the asset into cash. As long as you are replacing, you are not giving. But if you are really selling it and converting it to cash, and if there is a gain, then you have to pay the tax. So this is like a big advantage or encouragement for business to entities, to replace assets and buy the new assets. They don't have to pay tax on that. Trading losses you make. These arise when the adjustment to profit pro forma gives a taxable loss rather than a taxable profit. Remember, we just made a pro forma in the previous session where we were taking the accounting profit and converting it to taxable profit. If you remember from the previous session, we said that we had an accounting profit of $10,000. And then we said add back many expenses which were not allowed. And then we said subtract, deduct many expenses which were allowed. So these were numbers. So this is positive, this is negative, and you came out to your taxable profit. You created your taxable profit. And previous example, I assume that it was 9,000. So your accounting is a profit, taxable is a profit. What happens when you make adjustment to the profit pro forma and it gives you a taxable loss? So instead of coming up with a profit of 9,000, after making these adjustments, you might end up in making a loss of 2,500. And when this happens, you call it, you are making a trading loss, which means that your business is generating a loss. You are making a loss from the trading activities. Then what happens? Trading loss could be used in a variety of ways. So if you make a loss, what do you do? If you made a gain, if you had made a gain of 9,000, if you had made a profit of 9,000, you should have paid the tax at the tax rate. But if you are making a loss, then you don't have to pay anything for now. You don't have to pay the tax for now. Instead, what you can do with these losses, so you can think like, okay, if I make profit, I give something to the tax department. If I make a loss, then what happens? Then who comes to help me? When I'm eating, if I have food, I'll share it with you. When I'm hungry, is there somebody coming to help me as well or not? So when I make profits, I give you the tax. What happens if I make a loss? Do you have some rescue strategy for me? Because in good times, I was paying. Now I'm in a bad time. What will happen? So you can use losses in variety of ways. If the tax has already been paid for the earlier years, it will be refunded. Otherwise, the tax loss will reduce the amount of tax that needs to be paid for the next period. So either you, from the past period, if you have already paid it, you can refund it. But mostly what happens that you take it and you keep the loss in your books and you decrease your future liability. For the next time when you have to pay the tax, you will deduct that loss. So you have some other topics. I'm going to discuss group relief, carry back, carry forward current year against income and so on. So it has to be paid, reduce, and then you pay the less amount for the future period. You have one topic which is called group relief. By the way, this trading losses is an interesting topic, and we have several MCQs for that, because trading losses, like there is a special checklist I will give you, that if you made a trading losses, you can get relief from which type of taxes. For example, very interesting question you might be asking yourself, that you have a trading loss, which means from your operations you made a loss of 2,500. Then you have a capital gain. But I mean, on one side you made a loss, but on other hand, you made a capital gain of 10,000. Can you set off these two? You say, okay, here I lose, here I win. So let's make plus minus, and I come to a net balance of 7,000. You cannot. This is one question. So which income, which losses can be, deducted or taken relief from other sources of income? This is one question. Then another one is, can I go back and take the carry, losses adjusted from the past, or can we adjust the losses in the future? So how do we adjust these losses? How do we recover these losses? This is one interesting topic. You have group relief. This is an alternative way of using the loss and will reduce the taxable profits and tax due of another company within the group. So sometimes you have group entities. You have subsidiary A, subsidiary B, subsidiary 3. There are 3 companies in the group. One of them is suffering a loss. Other 2 are profitable. We call it a group relief. So, the losses of one are adjusted against the profits of the other. Capital losses you might have, like so far we discussed capital gain when you are selling asset or chattels. at a higher price than the book value, but you might be selling them in losses, capital losses. These can be carried forward against future capital gains. So if you made a capital loss, I'm not calling trading loss, I'm saying capital loss. You cannot adjust it against a trading profit. For example, I have a trading profit of 20,000. I have a capital loss of 3,000. So I cannot say that I will adjust my income. I will say, okay, my net income is 17,000. And now let's pay the tax on that. You cannot do it. You cannot say that, okay, from one activity I made profit, from other I made a loss. My net income should be 17 and I should pay tax on 17. This is not possible. You cannot do that. This you have to pay tax at 20,000. This one you can keep and you can move it in the future period against the capital loss. So capital losses are adjusted against the capital loss, against the capital gains. So capital losses will be adjusted against the capital gains of the future. So the tax authorities will say, keep this 3,000 capital loss in the books. In the next year, if you make any capital gain, you will subtract it. You will adjust it. So capital gains are adjusted only for the future, not for the past. This is also there. Capital losses are adjusted against the capital gains for the future period. They are not adjusted against trading profit, and they also are not adjusted from capital gains of the past. Capital gains of past, not. Only future capital gains. This is their only, rescue. Use this year to reduce capital profit. This year you can make, because you might have gain on one asset and loss of another. For example, you have two assets, three capital assets. This one capital asset made a loss, but other two capital assets made a gain. But the point is that all three of them are capital. They are not trading. Now you can adjust it. You can say, okay, 9,000. You cannot adjust it against trading, but you can adjust capital losses against the capital gains of the same year from other assets. Capital losses are never carried back or offset against other income. Number one, they are not carried back, which means that you cannot adjust them in past. And number two, they are not adjusted against any other income. They have to be adjusted against capital gains either in the present period or in the future period.